Hello friends, this is Sanjeev Kaushik and welcome to my channel Methodical Trades. In this video, I'm going to talk about 20 days moving average and its importance for those who carry their positions for a few days, say anywhere from 3 to 5 days up to 1 to 2 weeks. You see, when it comes to putting the moving averages on your chart, as you can see, I have the daily chart of S&P 500 open in front of me. And I have put on this blue line, which is 20 days moving average. Most of you would agree with me that any counter you take usually trade on the basis of mean reversion, right? What mean reversion means is that if a counter has gone away too far from its mean, at some stage it will try to revert and come back to trade near the mean line. If I have put on my 20 days moving average line, it means I am looking at the average price movement of S&P 500 in last 4 weeks. That is 20 trading sessions, which means 20 days, which means 4 weeks, right? So putting the 20 days moving average line will show me how effectively a certain counter is following the mean reversion principle. That is, if it goes away too far from its mean, does it come back and touch its mean or not? And if it does, which direction does it go from there? By simply looking at any daily chart and putting a 20 days moving average line will tell me two things right away. One, what's the overall direction from this counter, right? As this is the S&P 500 chart, and I'm looking at this chart in 2021 when the index was showing a bullish move. And you can do this practice on any chart. The idea is to show you the importance of 20 days moving average, so you can include the indicator in your own analysis while you're doing trading for a shorter duration, say max of 2 weeks. So what I'm reading here is two things. One, for sure, S&P 500 is complying with the mean reversion criteria. As and when the counter goes too far from its mean, it tries to come back and touch. The second thing that I'm observing right away is that the counter is in an uptrend. Why? Because every time it's touching the 20 days moving average, which direction it's going from there is important for me. Why? Because as long as it'll keep reverting to its 20 days moving average and it will keep going upwards, I know that the trend is upwards. Now, I'm not talking about shorting or going long on S&P 500. I'm only talking about a very basic analysis that anyone can do on an index. Now, if the index is following the property of mean reversion, can we also, in other words, say that the 20 days moving average will help us identify when exactly this counter becomes oversold or overbought, right? As we can see over here, whenever the counter comes down a little too far away from the 20 days moving average, it tries to go back towards the 20 days moving average. Similarly, when it goes too far away from the 20 days moving average, it tries to come back. So it not only tells me that this counter is complying with mean reversion, it not only tells me that the overall trend of this counter has been upwards in majority of 2021 year, but it also tells me when I can expect some kind of a reversal in direction because it cannot stay too far away from its 20 days moving average, right? The last thing that you can expect, and this is really the gist of this video, is that let's say you're going long in any counter and you're not sure how is it that you should set your target on that counter. Then consider taking 20 days moving average as your target. For example, in S&P 500, I know that the index dropped down to this level, right? This horizontal line. Now, if I'm not sure where exactly should be my target, I can very well consider 20 days moving average as my target. This is a very commonly used moving average when it comes to identifying targets. especially on counters that are exhibiting the mean reversion property, for which we already know what their direction overall has been, and they're also, let's say, oversold or overbought. So if you're going to short, right, let's say you shorted S&P 500 at this level over here when it was high, as you can follow my cursor, right? When you shorted over here, you'll put 20 days moving average as your target and you would want to exit. Similarly, over here, if you're shorting, you'll put 20 days moving average as your target. You will carry your position for a few days and you will exit, right? So 20 days moving average acts as a very good indicator to not only identify the direction, but also targets while we are trading on it. Now, one last point of caution before I wrap up this short and sweet video is when the counter does not reach its target from the oversold conditions or from the overbought conditions, then it means that that counter is not exhibiting the mean reversion property, which means the force by which it is going in one direction, that force will keep pushing the counter in the same direction for a decent period of time. As you can see, throughout 2021, the counter was pretty much playing along its 20 days moving average, right? It was coming back to touch it and it was going back again. However, the very first thing that I noticed about S&P 500 a few days ago is that it is not able to sustain its up move and is failing to touch its 20 days moving average. And if this starts happening, rest assured, you would know that the counter, in whichever direction that it is going, will keep going in that direction with a very strong force. As you can see, when S&P 500 dipped over here, it tried to go back up. It could not touch its 20 days moving average. It means the selling pressure was very, very strong. So I would not have any confidence in going long in this particular counter, because every time the counter fails to go back to its 20 days moving average and it reverses without touching it, that tells me the move in that direction will continue, right? As you can see, because it failed, and from there onwards, the counter kept dripping downwards. And interestingly, after so many days, it's the first time we're seeing a closure above 20 days moving average, which is a very positive sign. Now, I'm not saying that the weakness that we were supposed to see in 2022 has completely vanished and now we'll see a V-shaped recovery. No, the point is, it is always a good sign to see a closure above 20 days moving average. It is very widely used moving average, that is 20 days moving average. The pros know that whenever a counter moves from its oversold condition, its very first target that they should take is 20 days moving average. And whenever a counter comes down from its overbought conditions, the very first target that they should look for to exit their position is 20 days moving average. The positive sign that one should look for from here is consistent closure above 20 days moving average. If that starts happening, one can be hopeful that we will have some very good days ahead. Now, I'm not predicting whether we have seen the bottom or not, but this is the very positive sign that S&P 500 has closed above 20 days moving average. The moment I looked at it, I thought it's a good time for me to release this video and share with you all the importance of 20 days moving average. It will not harm you at all if you will always keep 20 days moving average on your chart and keep revisiting this video to just brush up on all the concepts related to this average line that I discussed with you. Thanks a lot for giving me your time, and I'll see you soon.